Good morning and welcome to MarketCast 14. We're back after an extended summer break, and I'm sure the very first thing that you will notice this morning is I've toned down my shirt. One or two people had said that it felt we were just going a little bit over the top with regard to the coloured shirts, the crazy shirts, so I thought I'd tone it down a bit. The sharp-eyed amongst you might notice the odd football club logo in there. I am not sure with this shirt made in China that it is official merchandise. So if it's not, for that I apologise. On to more important things. It's been a really busy summer in the property market, hasn't it? When I say busy, I mean busy difficult as against busy peak selling. We all know the issues that we're facing out there right now, and we're going to explore one or two of those today. Let's kick off with a bit of a summary of where we are right now. It's extraordinary how resilient the market is actually proving to be at the moment in terms of prices, but volumes are in trouble. I stuck this quote up here from my great mate Richard Donald from Zoopla, who I think is one of the really knowledgeable and more sensible people in the industry. And the quote on this month's Zoopla report, which says, "While house price growth has slowed, the primary impact of the higher mortgage rates and those headwinds have been in lower sales volumes." And here's another thing, that the lower sales volumes overall, in terms of the overall market, have been exacerbated in the new homes market. So we're seeing volumes for the developers drop further than the volumes in the second-hand market. But in the meantime, we've had two great bits of good news last week. On the Wednesday, we saw inflation fall, and I'll come back to that in a moment or two. We saw inflation fall, and then the following day, the MPC met, and on a knife-edge 5-4 decision, it was decided to keep base rates at 5.25%, which is good news for all of us connected in the industry, and good news for the country as a whole too. Let's start getting under the behind the detail there. I wanted to kick off with just showing you how the press are behaving during September. Well, you can see they're in roundly upbeat mood as ever. Here we go. This is Sky News. Bigger than expected fall in house prices as rate hikes hit the market, of course. Here's The Guardian weighing in, as ever they do. Proportion of UK house sellers cutting asking price reaches the highest in a decade. It's true. It is true. Even the FT are coming in here. Estate agents, gloomiest in 14 years. That's the good old RICS report. And I'm going to come back to the RICS report before we finish this market cast this morning, as we cram this in to 30 minutes. You get the general gist. And there were plenty of newspaper cuttings for me to choose from to try and demonstrate the message that is going out to the British public about the terrible state of the housing market. And yet, this is a really important piece of detail here. This is the GfK Consumer Confidence Barometer. Those of you that are regular MarketCast visitors will be well aware what this chart is actually showing. And it was updated only this week. And you can see, if we go from where we were back in September of 2022, that is after the Truss Kwarteng magnum opus, the mini budget that September, when confidence across all measures in the UK public actually hit an all-time record low in the 40-odd years that this survey has been running. And since then, you can see this improvement in confidence. Really quickly, to run through, and my apologies if you've seen it before, but to run through quickly what this chart actually means. So this line here is 0. Everything below that line means that the majority answer from the 2,000 people that get interviewed for this survey have actually answered in the negative. So when they are asked in this first line here, do you think the UK economy is going to do better or worse over the next year? You can see that right back here, a vast majority of those people said it's going to do worse. And you can see how that has improved. I'm sorry, I've made a mistake there. That is not the UK economy. That is their own personal finances. My mistake. So how is your own personal finances going to do over the next 12 months? And you can see it's improved. And we actually got to a point just at the end of spring and May, June time, when it was almost back to neutral, We had a couple of bits of bad news on the core inflation numbers and two interest rate rises in quick succession, and it dropped back in summer into July. But look how it's climbed again. And look, it's touching its nose on neutral. The British public believe that we are probably past the worst. And don't forget, these numbers were actually collected in the early part of September. So they were actually, this survey took place before the MPC decision last week to keep base rates at 5.25%. So that's really important too. Back to what I originally said that line was for, which is this one here. How do you think the UK economy is going to do? This is a monster low back here. This was a record low, September of 2022. And here we are a year later. We're right up here. So we're still in negative. Don't get me wrong. I don't want to create some rose-tinted spectacle view of how the UK economy is right now. But you can see it's dramatically improving. The green line here, do you think the next 12 months would be a good time or a bad time to make a major purchase? A kitchen, a car, etc. And you can see how that is slowly improving too. There is no question, absolutely no question, that while it is still in negative, that confidence is improving. And of course, confidence is the absolute driver in the decision-making process for house buyers. The red line, by the way, is the overall index score. And you can see that now just sits at minus 21. So still in minus, but a mile away from where it was at its record low back last September. So where does this take us? Here's the chart as it was, my little matrix, TM, that I use to determine where I feel the market is going to move. I thought it was worth putting this on. This was back in the spring, very similar to the one that I showed you last time we did MarketCast. And have a little look at where we've gone now. So, look at consumer confidence here and look at mortgage availability. Just have a little look at how that actually moves as we come up to date. That's quite extraordinary, isn't it? So consumer confidence now is it's only literally just sitting in negative, and it's moved back in terms of its impact, as has mortgage availability. Quite honestly, at the moment, the lenders are falling over themselves to try and lend people money right now, because obviously the falling volumes are affecting them too. The big issues that we're facing in terms of negative effect: high mortgage rates, they're still up there, we'll come back to those in a moment, and low affordability. They are the two big factors that are weighing heavily on the industry. As far as the positive effects are concerned, things like lifestyle changes and the employment market are moving back in terms of their impact. They are lessening off as the employment market is actually calming down, and those lifestyle changes have really fed through and people are going back to the office. Low supply, high demand has also changed, and it's moved back into a low impact position as more supply is coming onto the market and volumes of deals are also falling. And right up here in the positive effect in the blue, because these are the things that the developers can actually do. They are within the gift of the developers. Discounts sitting heavily up here. Look at part exchange increasing in its impact as the market starts to change and transition. And you can see financial products are in there too, obviously. We lost Help to Buy at the end of 2022. So the importance to try and enable first-time buyers who are desperately trying to get on the ladder in a red-hot rental market. It's worth making the point that we don't touch on the rental market in this MarketCast, but believe you me, right now, it is absolutely screaming hot, that market, as fewer and fewer rental properties are on the market and more people are looking to let them. In terms of the volumes, this is the big worry, and I think this is going to be our focus here this morning as we go through this MarketCast. If you look at mortgage approvals, well, these are the very latest numbers available to me, and you can see that mortgage approvals in July actually sunk below 50,000. Working on our normal calculation, if you bear in mind that mortgage approvals are generally about 2/3 of completions 2 to 3 months on, this means that if we've got 50,000 mortgage approvals here in July, that we are going to see September, October, that sort of time, completions right down at 75,000. So volume is the issue. That's the real concern and the real worry. I do hope that now we've got some stability. I'm not saying interest rates have stopped rising completely in this phase, in this cycle, but certainly what I think we've got is some stability. And if there's another rise, possibly another 25 basis points, depending on how the economy runs, well, then that's probably as much as it's going to be. Even Andrew Bailey, the governor of the Bank of England, deliberately signalled that we were near the top of this current cycle in terms of interest rates. But the point being that volumes are low, and this is where everybody's struggling. If you talk to any developer anywhere, it's all rate of sale that is the major concern. If you look at new buyer registrations, you can see that the demand has actually started to come back a bit. This is a Property Mark chart. So these are a group of independent estate agents, are all members of Property Mark. And you can see that their August numbers in terms of new buyer registrations has actually increased, something that you wouldn't expect necessarily to see in August. So, there is underlying demand there. There is no question. We've seen, and we've talked about this in MarketCast before, haven't we? Where this transition from the spring of last year to where we are now has been all about a change in market from a wants-based, I would love to live in a house on the hill, to a needs-based, we need more space. And that change from wants-based to needs-based is really what the market is made up of right now. And the thing is, needs-based market is there, whatever the interest rate is. If you're having an addition to the family and you need additional space, it doesn't matter whether interest rates are 2.5% or 6.5%. You need that space. So let's have a little look at how those key factors that affect the market have changed since we last met on MarketCast. Here's the inflation, and you can see this was the end of lockdown here. This was February 22 when Russia invaded Ukraine. And you can see that screaming interest rate. And of course, the Bank of England was slow to respond to that. The first rate on those 14 base rate rises, the first rise didn't come till December of 2022, December 2021. And then since then, of course, we've seen 14 consecutive rises because by that time, the greyhounds were already out of the slips and we were away on this inflationary spiral. But you can equally see how we have gone over the crest and we have come down the other side. Lots of people, lots of economists, lots of commentators out there expected inflation to go up in August. And I am delighted to say that it fell from 6.8% the CPI to 6.7%. That was great news. And of course, the timing of it was just perfect, because it came the day before the MPC met on base rates, and that meant that they decided to hold base rates at 5.25% when the markets were, it was baked in, wasn't it? There was going to be another 25 basis points rise. It was going to go to 5.5%. That's what the markets were expecting. And it was held steady. And so, of course, that had a good effect on the swap rates between the banks and the institutions. And there are a number of the larger institutions are out there right now with offers on mortgage rates trying to tempt people in, the 5-year money in particular. So this is how interest rates have been running up until that point. These are the very latest numbers I've got, which unfortunately are only up to the end of August. I'll update this as soon as I can, but you can see the direction of travel here. It's very, very clear. These are interest rates on 2-year fixed for various different loans to value. And you can see that the worst of them, a 95% loan to value, is actually right up there over 7%. But the best of them, down at 60% loan to value, is down there nudging down towards the 5% mark. And when you look at a 75% loan to value mortgage across different terms, you can see how the 5-year and the 10-year money is really starting to get competitive. There are rates out there on 5-year under 5%. That is the market saying where we think rates are actually going to move. And I think once we get this mentality that says, that realizes that very, very low cost money, the old 1.5% and 2% mortgages are now a thing of the past, or certainly for the foreseeable future at least, then they can get on with their lives, they can make their moves, and we'll start to see the volume come back into the market. I know that paints quite a rosy picture at what is a very difficult time, but that's how I see it. We'll come to where I think the market's going to move the back end of this year and the first quarter of next year towards the end of this market cast. The big indices are always worth putting in the deck, and I know that you'd expect me to include them. So on asking prices, this is Rightmove. Actually, was an increase in their September numbers. Don't be fooled by the increase in the September numbers on asking prices. Number one, they are asking prices and not sold prices. And of course, we have got a greater percentage of those asking prices being discounted by sellers before they can actually get a sale. And number two, that's quite a way below where we would expect it to be moving from August into September. I think the average, from memory, I think the average for the Rightmove increase at this time of the year is 0.6%. So it's quite a bit below the average that you would expect. So it's not necessarily as good news as you would think. Hopefully our engineer's not dying over there. I hope you're all right, James. Keep going, you can do it. So you can see it looks great news as a headline, but it's not, it's not as good as it appears at first glance. If you look more at mortgage approvals and sold prices, here's the Halifax, and you can see that in their August numbers, which is the latest I've got, we're obviously right on the verge of getting the September numbers at the moment. August was minus 1.9%, and you can see then that that took the annual change in the Halifax numbers down to just under 5% compared to last year. I stress, and here's Zoopla, but let me just take you back to the Halifax for a moment, because the nationwide numbers are very, very similar, minus 5.3%. But I stress that is this year, that's 2023, measured against 2022 when the market was absolutely flying. Now, all of the people out there that went to the press, that screamed the headlines saying, we're going to see a 30% fall in prices. I'm sorry, but this is a really clear demonstration that just hasn't happened. I'd like to reassure you all of the viewers of this, that I was not in that group. And this was always where I saw this market running out through this year, at that -4, -5, -6% number, depending on which index that you actually prefer to reference. That was where it's going to be. And that's measured against a really high level of prices, historically high level of prices through 2022 and into this year. So it's difficult, but it's not disastrous. And if you look at the Zoopla index, and of course, Zoopla have got that unique algorithm where they take a raft of asking prices and mortgage approvals, sold prices, and they blend them together to give a more balanced view. And you can see that their index, their August index, actually showed a tiny little bit of annual inflation at plus 0.1%. So they're saying that for Zoopla, the market is about flat. If you look at their city index, the reason I've included this morning is this is quite interesting, because at the height of the market, if you go back to the autumn of 2021, when the market was absolutely flying, the difference between the best performing city, and I think Nottingham during that year was the best performing city, down to the worst, which I think was Aberdeen, was like 14% difference. Extraordinary. And what's happened as the market has got more difficult, that difference has compressed. That regional difference has compressed, and I found this very interesting. And if you look now, there's Aberdeen still, unfortunately, poor old Aberdeen, oil town there at the bottom of the table in 19 at minus 1.6%. But at the top, Edinburgh and Nottingham still closely following it, but only 2% growth. So the difference now has actually compressed between the regions to less than 4%, according to Zoopla. And I thought that was a really interesting facet of the way that the market has moved and changed. Right, I've stuck an RICS chart into this deck because I wanted to share this with you this morning. This comes from the RICS August survey. Do you remember that little newspaper clipping from the Financial Times that said, the agents are all flinging themselves out of off high buildings and at the end of Bournemouth Pier? Well, here we go. This shows you the RICS survey, and this shows you over here the price expectations of the surveyors. So as your blue dotted line is where they think prices are going to go over the next 12 months, and the solid mauve line there is where they think prices are going to go over the next 3 months. And you can see here are the regional agents and surveyors are where they expect prices to go. Do you think they're going to go up, or do you think they're going to go down? Hey, guess what? Have a look at that. Just let's delve into that. I mean, I have issues with the RICS surveyors. I'm sure that those of you who watch MarketCast regularly will know. It's a very, very low sample size. And so I think that's something that we really do need to consider. It's carried out amongst people that actually, well, if you like, have conflicting interests. Let's take a look at this particular survey here, this particular piece of detail here in a bit more detail. So this is this August chart, and this is it dating all the way back here to 2000. So let's just have a look here what happened here. This is 2020, so we are just coming into lockdown. So this is, COVID-19 was just happening, wasn't it, at the beginning of 2020, and everybody thought that the world was going to end. And here were the surveyors here, and this is the balance of the number of surveyors that thought prices were going to fall over the next 12 months back here in 2020. Let me just align that chart there with the change in the average percentage price for UK property according to Nationwide, which to my mind is still the most reliable currently of all the indices that are out there. Here's 2020 back here. This is what actually happened. So if you actually take these two charts and you align them and you say, so this is what the surveyors said were going to happen, and that is what actually happened. Now, don't get me wrong. I know that 2021 surprised everybody, myself included. But heavens, didn't it ever surprise the surveyors and the estate agents throughout the country? And that is why when I look at the RICS numbers and I see it down here, I see this change and then that change, and I see them all absolutely looking in their boots. And I think that doesn't necessarily provide the rock solid guarantee on prices that I used to consider it did way back in the day. So the agents are very downbeat. They still see that it's going to be, the vast majority of them see that the price movement is going to be negative over the next 12 months. I'm not so convinced. I think that next year is probably going to be flat. I don't think there's going to be any growth. I think it's probably going to still be negative growth in the first quarter, but we'll come to that next now as we start to run out of time. Okay, so let's just take a look then at the final quarter of 2023. This is my little chart here where I actually plot the actual movement in the Nationwide index as against the forecast movement in the Nationwide index. So the blocks in there are the percentage, the annual percentage change in price according to the Nationwide, which, as you know, is based on mortgage approvals. Now, I am pretty pleased to say that if you go back and check out the MarketCast back in the spring, this is pretty much as we saw it, even allowing for a little uptick in average selling price, which is the red line, by the way, the solid part being actual, and then the dotted line being my forecast. So even allowed for the uptick in average selling price in the UK back last spring. It still meant that the annual inflation rate was in negative, and certainly that's where we've been. So right back here, so this is January of this year, we can see that we were still in positive growth, and then it fell into negative through the spring, and it's come down, and in August currently we're at minus 5.3%, pretty much exactly where I said it would be. That is where we are. But here's the shocker, and here's where I take a huge risk, because the Nationwide numbers are due out, I think, the day after tomorrow. I think it is. It might even be Monday. I'm not certain. But we're right at the end of September, and Nationwide publish always right at the end of the month. So we are about to see their numbers any minute now. So I could really be cruising for a fall here. But I believe that there will be an uptick in the average selling price in the Nationwide index. Tiny, but a little uptick in that average price. It will still be in negative inflation. So the annual number compared to this time last year will be negative, but I think it will reduce from minus 5% to somewhere around -4%. I think there will be an easing in the rate of fall of price in the next month, and I think that will continue into October, and then I think it will pick up pace again, coming to around -5, -4, -5, -6% by the end of the year. So this is where I see it going, and we will see then that average price dip away as we move into the end of the year. That is how I see the back end of this quarter. So if you like, very, very similar conditions to those that we're trading through right now, with our big issue, as I'll stress once again, being more volumes than price. But so how does this affect the new homes industry as against the rest of the market? And I think this is where the majority of the viewers of this market cast really do have to consider this as an issue. Unfortunately, these numbers, which are the very, very latest numbers, I went back online yesterday just to check to make sure I had the most up-to-date numbers available. They date back to last May. These are land registry numbers. You can go and look these up yourself. These are not an invention. These are rock solid data. So you can see here, this is land registry data for the average selling price of a new home in the UK. Land registry data for the overall average selling price of a home in the UK. And you can see that the gap between the two I have called the new homes premium. They've been measuring this since 2005, and during that time, at its narrowest point, which was following the really bad recession in 08-09, it got down to 14%. The average across all the years, almost 20 years, 18 years of measuring, of this measure being in existence, is 24% overall. Right now, it sits at 42%, 42%. But over the last couple of months, so for the March, April, May numbers, that gap has stopped growing and has actually started to shrink marginally. So it's gone from 44 to 42. We've obviously moved on a long way. These are May numbers, and I don't know yet because the data isn't available, but my gut feel here is that that gap has continued to close. And that is where the issue sits, that premium that the new homes industry managed to grow and grow and grow when during 2021 and into the first half of 2022, property was in such short supply, demand far outstripped supply. And obviously you can only sell each piece of inventory that you've got once, so you make best advantage of the market conditions, and you obviously drive best price that the market will allow. And that's where the industry sits at the moment, and I think there's an issue there. I also believe that the city have baked in a substantial reduction in volumes on new homes, certainly the quoted developers for 2024, and I think that comes through too. But unless there is an adjustment on asking prices to match that, then the industry will struggle against the second-hand market. And if we've got falling volumes in the second-hand market and the industry loses a bit of market share as well, that really does put sales rates under pressure. You can see where volumes have gone, and for me, volumes are really the big issue. At the start of the year, I predicted that we'd be around about 1 million completions as against a normal pre-COVID average of 1.2 million. I think we might even dip below that. I think that the number of completions at the end of the year will be between 900,000 and 1 million. And crucially, I think that the new home share of that market, so the spec build, the open market sales of that market, will probably fall under its medium-term average of around 12%. I think that could come down closer to 11%. So that is quite a substantial reduction in volume, and it means then for a developer looking to maintain sales rates, they're going to have to increase their market share with whatever technique that is. Think back to that property matrix right at the start of this deck, and that gives you some sort of sense of where we are. Okay, we're coming to the end now. I don't want to be running over on my first market cast back after the summer break. What's going to happen next year? Well, I actually don't think it's going to be as bad as commentators are actually saying and predicting, particularly in the national press. I think it's going to be better than people think. I think we're still going to see a fall in values in Q1 next year, but not by much. I think that fall in values is going to ease as people get used to the new world, to the new normal, if you like, on interest rates. I think we're going to see our lowest point just prior to the spring. So, that dark depths of winter moment at the end of February, that I think is where we're going to see the lowest point in the market. And I think there'll be a little bit of a recovery in March. Negative inflation sitting at around -3%, sitting at around -3% by the time we come to the end of the first quarter next year. The big issue is going to be volumes. It's going to be the numbers of sales, with averages that's struggling for the new homes industry to get over 0.5 of a sale per live site per week. And that's the really important number, because the cost to try and drive that volume is so very, very high. So new home share will still be under pressure in the first quarter of next year. So in summary then, there we go. Unexpectedly good news in August with inflation falling, interest rates held at 5.25%. Asking prices are still falling, and we know that the power has shifted from seller to buyer during this time. But that crash, that widely predicted crash, well, we can see it's not happened so far, and I see no reason. There are no signs that I see out there to make me think that it is going to happen. That gap in the new homes premium, consider that, and consider a reforecast of where we are in terms of asking prices on new homes. And I'm seeing that we're going to end the year at around -5%. Pretty much where I always was, in between 4 and 6%. And I'm still absolutely there. I'm seeing volumes now perhaps a little bit lower than I originally thought, probably between 900,000 and 1 million, and also new homes share falling to around 11%. Okay, that's a couple of minutes overrun, so I apologise for that. There's been a lot to squeeze in our first MarketCast coming back after the summer break. MarketCast 15, which I think you will agree looks very sexy with an X and a V there going on, is on Halloween's Eve. So you can imagine the shirt that I'm going to be wearing for that one. So prepare yourself. We'll have lots of new data for you and an update on where we are positioned in the market. So big thanks to poor old James there, who has slogged his way through this morning's presentation, and to Hannah, who's been driving this for us this morning, and Joan as well. So big thanks to the production team. And I will see you lot again on All Halloween's Eve.